Hey guys, welcome back to another video. Today I'm joined by a very special guest, Nathan. Nathan, do you want to quickly introduce yourself?
Hi, I'm Nathan. I'm from Cox & Company, a firm of accountants based near Manchester Airport. I work alongside with yourself on your property investment venture. We specialise in accounting, tax and property.
Yeah.
So basically, we're like another accountant, but we have more of a focus on property, if you like. So we are a specialist in property.
Awesome. And I've asked Nathan to come onto the channel today because I'm getting so many messages from people asking me about, accounts, tax, all these different things that I'm not necessarily qualified to answer. And so I just thought I'd bring Nathan on. We could have a chat and you guys could maybe listen in to our conversation. Now, just a disclaimer. This video is not advice because everybody's circumstances are different. If you want to get actual advice on your personal circumstances, then make sure that you click the link in the description to schedule a call in with Nathan. This is more like a video for information.
It's more of an introduction, isn't it?
Just an introduction to the basics of accounting and tax.
Correct.
Within property investing. So I'm just going to jump straight into it and ask the first question, which is, what is the job of an accountant?
So an accountant's job is actually quite varied when you actually look at it. You've got people that work in industry, but you've also, probably more specific in terms of property, is you have accountants in practice. Now, what our job as an accountant is to work alongside clients who would like help and support in managing their accounting and tax affairs. But also, more recently, we have now become more software engineers and we have become more software developers, and we like to develop our clients' businesses with the software. Ultimately, you can break it down into three sort of areas. You can break it down into compliance, you can break it down into tax advice, and ultimately you can break it down into efficiency and driving for business growth. Each accountant in their own merit has different ways of doing things. But yeah, in a nutshell, we're there to kind of help and support, guide you through the rafts of compliance and tax legislation to make sure you're tax efficient.
Fantastic. Now, I get a lot of people messaging me, and it feels like there's an assumption that when you pay for an accountant's services, it is therefore the accountant's responsibility to do everything and fully look after the accounts, and the business owner or the investor themselves doesn't take much responsibility on. So could you just clarify that and also explain almost what a business owner's responsibility would be when it comes to investing in property and their own taxes?
So ultimately, everything within the UK, you are self-assessed for, hence the name self-assessment. If you have a company, you form a self-assessed corporation tax return. You sign that as a director. Tax responsibilities are always on the taxpayer, not an accountant. It is very important to remember that. Now, when you actually engage an accountant, they will engage for set services. And effectively, if we are, like my firm would be engaged to do a tax return, for instance, we are engaged to do that tax return. Given the information is given in a timely fashion, we are supposed to use professional competence to complete that and calculate it on your behalf. If there's missing information, we have to come back to you and relay that to you. But ultimately, we are there to represent yourselves basically on the information that's presented to us. We always send out lists, etc., but the responsibility is always down to you as an investor. What I'd also say is an accountant would never really get involved in actually looking at the viability of a project because that's more investment advice. If the investment were to go south or go a different direction, then effectively the accountant could be deemed being responsible. So although we will try and help and advise on a particular project, ultimately, it's down to the investor to make sure that they've chosen the appropriate project, manage it correctly, and are fully compliant with tax laws and the legislation in terms of company accounts.
Yeah, fantastic. Now, if somebody wanted to set up a company, what's the best way to go about that, or what are the different ways to go about it?
So ultimately, it's down to competence of the person doing it effectively and how confident they feel in being able to do it. Now, you can go direct to company's house and actually form a company through there. The process is quite easy and straightforward. But you might want to have a little bit more help, and you might want to use a formations agent. Now, a formations agent, what they will do is they will take the information in a nice format for you, so that effectively all the information input into their data streams. They then form the company on your behalf. And the third and final thing that you could do is you could ask your accountant to do it.
Yeah.
And your accountant can make sure that everything's done, everything's ticked off, and you are where you are effectively, and that your company gets formed within your expectations. They are your 3 ways of forming a company effectively.
Fantastic. So it can be quite simple, really.
I'm bound to say it can be quite simple because I do it every day.
Yeah.
However, I have had people historically come back to me with problems when they've formed a company. I'd say it is relatively straightforward. If you follow the instructions and just fill the form out effectively, I'd say the majority of people could use your formations agent to do it.
Yeah, to be honest, I say it's simple. I set mine up on Company's House. I did that before I was introduced to you guys. And it felt fairly straightforward. First time I'd ever done it, and it felt straightforward, but I was a little bit concerned I got something wrong. So maybe some people would find it helpful to just know that an accountant had done it and done it properly. I actually had someone message me on Instagram 2 days ago. They're asking me the question, and I'll come to this question later. Do I buy in a limited company or do I buy in my personal name? And like I said, we'll cover that in a bit. But I advised him to speak to an accountant, and he came back to me and said, "Yep, they've said limited company for his circumstances."
Of course.
And he said, "How much is it going to cost me to set up a company? Is it about £1,000?" And I was like, "Well,
if anybody would like a company and they'd like to be charged £1,000, I'm open for it. What I would probably say is to form a company, it's probably around the £150 mark, obviously plus VAT. Depending on the nature of the job, effectively, and the complexity of it, obviously, and the more time that's required, you can have company formations at £50. Ultimately, it's down to the deal that you do with your accountant. But I'd certainly say £1,000 is a little bit rich for a company formation.
So it's not £1,000 for people who are thinking that out there. Great. Then the other question that I had is, and you may be slightly biased, but how do you pick the right accountant? Or is there such a thing as the right accountant?
Well, ultimately, what I'd probably say with picking the right accountant is it's much like looking for a builder, plasterer, electrician, dentist, doctor, etc. It's down to the sort of the person and the skill set that you actually want. I mean, in essence, accountants are, by virtue, a build-up of their own experience. So what you can actually get is you can get unqualified accountants that profess to be accountants effectively, know the rules, procedures, but actually haven't gone through the professional standards. If you are involved in property, I would probably say avoid them because they can't help you in terms of with your finance, your funding, because you have to be qualified to actually put your name and your signature down to help you with the funding.
Just before we move on from there, could you give me an example of what you mean by that, helping with your funding?
So, if you're applying for a buy-to-let or you are applying for a bridging finance or anything else, the finance company will want somebody with some level of responsibility or qualification, an accountant, a qualified accountant, to actually substantiate those figures of how they've been derived. Qualified accountants aren't able to do that. So it's very important if you're starting your property journey to make sure you've got the right partner that can help you to nurture you to grow financially.
So finding the right accountant, it's almost like a know, like, and trust, but also, especially within the trust element, do they have the right experience? Do they have the right qualifications?
What I would also probably say is if you, like anybody, if you are looking at an accountant, you want somebody who's actually got the experience themselves personally, because ultimately, me as an accountant, as an example, I have properties, I'm involved in property. I've had to rein it back in recent years because I've started my business and because of COVID, but effectively, I'm always looking for myself for the tax advantages, and because I do it as a day job, and I've got skin in the game, I've got sort of a self-serving interest. So effectively what you're looking for is you're looking for somebody who's proactive, uses technology, but also has some skin in the game effectively, so that they're giving you the advice that they use themselves. That is probably what I would probably suggest in terms of property.
No, I like that you say that I have skin in the game, and I know for a fact you're very confident in your own accounting skills as a company. I won't forget the first call I ever had with you. We had a chat on the phone, spoke about my situation. At the end of the call, you went, Right, okay, so you didn't say, oh, now do you want to sign up to our account? You went, okay, now go away and speak to 5 other accountants and see who you want to go with.
Correct.
And I was just like, oh, okay. So, and I went away, spoke to all of them. Not a single one of them said that. They all tried to pitch me this package that they had, or this, accounting bundle that they'd created at a discount or whatever. But you were just like, not selling. It was just, if you want to use my services, you can, but go and check everybody else out first and see what you think.
I think essentially, when you're looking for an accountant, it's a very personal experience. At the end of the day, the one thing that people actually hold closer to the chest than their own birthday suit is effectively the finances. And I actually think that choosing the right partner, it has to be open and transparent. I mean, don't get me wrong, there are always fees for doing things, but that shouldn't be the first and foremost thing that comes at you. You're after, the reason you go to an accountant in the first instance is you want the advice, you want the help, and you want the best performance to do it, whether it's software, etc. So I think when you're looking for an accountant, you want looking to start a relationship, and it should be a long-term relationship, because people naturally move accountants when they found other ones, and referrals are great, but at the same point in time, once you've had a referral, you still need to make sure you see what else is out there on the market, because you want somebody to be there, sustained through your growth. I think it's very important. I mean, sometimes people come to me and obviously they don't come back because they found someone cheaper. It's just the nature of what it is. At the end of the day, it's down to that personal relationship, is what I would say.
Definitely. Fantastic. Quick one. Does location matter when it comes to choosing an accountant?
So, location, I would say, given the rise of technology, given the rise of Zoom, given the rise of all the available applications you can now use, I wouldn't say that location is actually required as part of your search. What you're effectively looking for is the best possible advice for you, given that everything can be done electronically. Using software to submit your receipts, using Xero to do your accounting effectively, that's readily available. So what I would probably say is location's not required.
Yeah.
If you want a meeting with an accountant, you want a meeting every 6 months face-to-face, location might be something you look at. But if you're happy to use Zoom, Skype, etc., much as we have had to do recently, then I would say location isn't really a necessary factor these days.
And also, if you're meeting up once every 6 months, a 3-hour drive even isn't that big of a deal.
Correct.
When I started working with you guys, when we formed our partnership, it was I was in Birmingham and you were here in Manchester. So, and that didn't bother me at all. It worked really well.
Yeah.
You touched on accounting software.
Yes.
Would you say accounting software is essential, or can somebody, not necessarily can they do it with spreadsheets, because they can to an extent, but what would you advise for most people, or not even necessarily advise? What are the pros and cons of both?
Yeah. What I'd say is start with the type of person that you are. We have clients that obviously drop in shoeboxes full of receipts, and there's always bits and pieces missing. I can give you a few examples where I've gone outside and it's a work van, and somebody said, oh, just hang on a minute, I'm going to pull all of these out my work van, and gives me another bundle of receipts because the tax bill's too high. They have a full sort of service right from the ground up, effectively. If you do the next step, which would essentially be a spreadsheet, as long as you're the type of person that is organised and meticulous and that you're not going to lose receipts, then effectively a spreadsheet can work for you, but you have to be meticulous in its build-up. I'm an accountant, and obviously I'll admit it, I lose the odd receipt. So what I decided to do is effectively use software where you can simply take a picture of a receipt and then you can bin it. That digital receipt effectively is there forever, and it's done at the point in which you've got it. Whereas if you take it to the spreadsheet at the end of the evening, something might come up and you might miss that effectively. So although you can use a spreadsheet, sometimes it's better and more efficient to use software. Ultimately, you need to decide on what kind of person you are and whether you are diligent enough to enter that information into that spreadsheet consistently.
Yeah.
If not, I would probably say use software. It makes you more tax efficient, and it is actually more efficient than typing data on a spreadsheet by nature. You should always balance that with cost, effectively.
Yeah.
Because
how much are you looking for? Or if you're looking at accounting
software?
If
you're looking at accounting software for a single business or a single part of your business, effectively, then you're looking somewhere in the region of about £30 to £50. Now, software companies have realised that effectively a lot of people have made the move digitally, and by virtue of that, what they're now doing is upping their pricing. So what you're looking for is basically an accountant that can provide you that software and perhaps provide you a discount for their relationship with a software provider.
Yeah.
But ultimately, anywhere between 30 to 50 is the sort of cost base you're looking for per month.
So the question really is, well, it's two. Are you diligent enough to look after your physical receipts, which
Correct.
I'm definitely not? And also, is it worth it versus the cost?
Correct.
Yeah, I think that's great questions
Yep.
to ask. Now, a lot of people ask me about different taxes involved with property, investing, and all that type of thing. So I'm just going to throw out a few different taxes, and it'd be really helpful if you could just give a quick definition of those taxes, if that's okay. So the first one is corporation tax.
Yeah. So what I would say with corporation tax is limited companies only need apply effectively to this. And corporation tax is exactly what it says on the tin, to quote a paint provider. Essentially, it's corporate tax. So it's tax on a limited company.
Yeah.
Now, what you have is you have a mechanism where you've got your turnover, less your costs, gives you a profit. With property, you have something called chargeable gains, but just assume that they are both the same, effectively. It's still your turnover or your sales price of your house, less your development costs, gives you a profit. The current rate of corporation tax is 19%.
Okay.
There are some changes, and it may move up to a 25% tax rate in the next couple of years. It's not yet been released. It's going to be on a marginal sort of rate basis. But effectively, corporation tax is your tax on limited company profits at a rate of 19% current.
The next one is capital gains tax.
Of course. So, capital gains tax. How would I describe capital gains tax? So, capital gains tax are on items that are held for investment purposes. So, if you hold shares in a company and you buy them for £1 and you sell them in 5 years' time for £5, you'll have made a £4 gain. It's a capital gain. You've held it for investment purposes. It differs from income tax because what you would do effectively, if you bought a car, and we use a car as an example, you held it and then you sold it, not that happens very often, you would have a capital gain there, effectively. If you were to start doing it more often, and you were doing more and more car sales, you need to be aware of the badges of trade. And basically what that means is it's a switch from capital in nature to income in nature, because effectively you've changed your way of doing business, and you look more like a trade. So capital, it's really important to make sure at the outset of any project that your intention for doing something is a capital in nature. An example would be a buy-to-let property. You're buying it to let it, it's a long-term investment. Whereas if you're tending to do property-based flips, and you're doing them consecutively, that's more income tax in nature. Now, with capital gains tax, every person in the UK has an annual exemption, and it's much like the personal allowance. The current annual exemption is £12,300 per annum. So that means you can make gains every year as an individual of £12,300. Much like with income tax, you can have an income of £12,500 every year, where you don't pay any income tax. So it's exactly the same sort of relief, just a different amount, effectively.
Yeah, fantastic. Income tax.
Yes. So income tax is obviously your tax on your income. So you'll all be familiar with employment. So you have something called pay as you earn. So when you have income as a pay as you earn, you pay as you earn effectively your tax. If you become a sole trader, then effectively what happens is you've then got to pay your taxes every January. So an accounting year runs from the 6th of April one year to the 5th of April the next. You then have until the 31st of January to file and pay any tax that's together. So income tax is everything. It's an accumulation of all your income from sole trade, dividends, and whatever else that you've generated within a year, and then you are taxed at the marginal rates of tax. I'm not going to go into the marginal rates of tax at this point because there are a lot of them, but essentially, that's why you go to an accountant in the first place.
Yeah. And then the last one that I wanted to cover is stamp duty, SDLT.
So stamp duty is basically, it's a very old tax. It's probably the oldest tax legislation we have to date. And effectively, it's exactly what it says on the tin. It's a stamp. And what you have to do is you have to at certain transactions, whether it's a share sale or a share transfer or a property sale, you will have stamp duty to pay. That is the legal document in which is stamped, effectively. The taxes are then paid and it becomes legally binding. And stamp duty within property, again, I'm not going to go into the rates. There are, at the moment, because of COVID, there are certain allowances and other bits and pieces, but stamp duty can vary effectively on the rate. So it's important that, again, you look up any stamp duty that might be payable on the purchase of a property. It's only on that purchase, it's the buyer that always pays the stamp duty.
Yeah. So just to go through quickly, so we've got the 4 taxes that we've just covered: capital gains, corporation income, and stamp duty. If I was going to buy a house and flip it in my personal name, what taxes am I subject to?
Stamp duty, capital gains tax, effectively. If you have a history, though, as I said before, and this is why you need to look at the nature of it, if you were doing one and you were going to hold it for investment purposes, then effectively your intention, it might be capital in nature. But if your intention is to buy, sell and flip consistently, then effectively that might be income in nature. So it's extremely important that you go back to the drawing board, understand what you're doing and why you're doing it and what the intention is, because otherwise badges of trade may come into play effectively, and take that from a capital gains tax rate where it's more favourable tax-wise and take it into an income tax rate where, depending on your other earnings, can actually be less favourable. The intention is always the reasoning behind something. Okay.
And then in terms of buying and selling property in a company structure, you're subject still to stamp duty.
Still to the stamp duty, but also to corporation tax. And to some degree, if you want to take your profits out, you need to extract that out of the company. And if you're extracting the profits out of the company, you can either pay yourself through pay-as-you-earn, a salary, which adds to your income tax, or through dividends, which again form part of your income tax. So there is a mixture for a property investor developer, if you like, of various taxes at work depending on the appropriate structure.
I get a lot of people asking me questions about how do you pay yourself and all this type of thing. I'm not even going to ask you that because I know it's different for every single person. So all this type of thing that we're talking about, what are you subject to based on your circumstances, how you're buying, how you want to pay yourself, all that stuff, it's too personal to go into on a video like this.
It is.
So we won't jump into that just yet.
Effectively, what I'd probably say is you've got to look, just as a rule of thumb, you've got to look at your personal tax banding. You've got to look at what your, if you're married, if you've got a partner, and what their tax banding is. And then you've got to look at what the future looks like and what you want to do and what the intention is. Because dependent upon that track that you actually speak to your accountant about will actually dictate which route to go effectively. A limited company, a lot of accountants like to push a limited company, but it's not a one-size-fits-all approach effectively. Some clients, and starting out, it may be worthwhile if the basic rate taxpayers to have the first 1 or 2 properties in their own name effectively, because therefore they can use the annual exemption for capital gains tax if they sell, whereas if you move it into a company, there is no annual exemption.
It almost depends as well on what your current income is, how much profit you're planning on making on those deals, and it's so bespoke.
It is.
So I want to explore a question that is probably the most common question, especially for people who are just getting started in property. People ask the question, should I buy a buy-to-let or a flip in my personal name or in a company name?
So it's a very interesting question, that, and if you just go back to what we've just discussed, it's dependent upon your own circumstances. There are tax efficiencies in putting things into a limited company. There's also a vested interest for accountants to put you in a limited company because of fees. Might not necessarily be the right thing for you. What I would probably say is you also need to look at your finance and your funding, because if you hold the property in your own name and you do it in your own name, you get your annual exemption of the 12,300. But the interest rates from the bank charge are also lower. Whereas if you put it into a limited company, yes, it's more tax efficient, but you end up paying more in interest. So what you have to do is you have to look at a cost versus benefit analysis of which one's the right for you, but also look at your overall tax position. So it's quite a difficult one, but one that an accountant, a diligent accountant, should be able to guide you through, given your own personal circumstances.
The reason why we talk about being tax efficient and being able to offset costs and things like that, that very much is down to Section 24 and what's come in at the moment. Could you just explain Section 24, what it is, and the implications for a property investor?
Of course. I mean, if you do a quick Google of Section 24, I think every accountant out there under the sun has now done something on this, but I'm more than happy to cover it. It was introduced in April 2017, and effectively what it was done for is to reduce the appetite for buying properties and have it holding them for rental effectively. It was to slow the market from moving. So what they've effectively done is quite a lot of people that are able to buy properties are higher rate taxpayers. You don't often find basic rate taxpayers buying property effectively or at scale. So what it is effectively a tax on higher rate taxpayers. Where you used to be allowed to have your full interest, mortgage interest deductions and take that off your rental income for the year, that would derive your profit. What happens now is you're taxed on the top line, your rental, and then you get a relief at 20%.
Yeah.
So effectively, you're only getting the relief at 20% as rather than 40%. But because you're taxed on the rental turnover, as it were, first, it's easier to hit the higher rate tax bracket where Section 24 comes into play.
Yeah. Okay, so, it could be that somebody has in fact, do you have a couple of examples that you could maybe throw out to explain a little bit about what that would look like and the implications of that?
Of course. Let's say that you've got £15,000 worth of rental income and you've got £5,000 worth of interest. Now, traditionally, you used to be able to have the 15,000 less the 5, which gives you a taxable profit of 10, because you used to be able to have the full interest deduction, and you used to get the tax relief at 40p in the pound against the 5,000 because you're in that higher bracket.
Yeah.
What now happens is you're now taxed on the 15,000 turnover, as it were, and therefore a basic rate taxpayer is taxed at £3,000, and the higher rate taxpayer at 40p in the pound is taxed at 6,000. What then happens is you then get your relief, and you only get your relief at 20% of that £5,000 interest, so it's only £1,000. So effectively, a basic rate taxpayer pays £2,000, and a high rate taxpayer pays £4,000. So because you have the income shift across the top and you only get the 20% relief, it only targets the higher rate taxpayer being a 40p taxpayer.
Yeah.
Whereas you're getting the same relief on the 20p, the basic rate, because you're getting 20% tax relief.
Yeah. So really, when it comes to choosing, do I buy in a limited company or in my personal name?
Yeah.
It's not even like everybody's personal circumstances are different and then you pick one and you stick with it. Yeah. You almost do need to look at it on a deal by deal basis, because it could be that you have a house that you flip and you get to benefit from the exemption, the tax exemption.
So what I would probably say is you should always review your own circumstance, because we're all, by virtue, creatures of habit, but we also have change. We also have changes implemented on us, such as tax legislation that comes in the Finance Acts. So it's always well worth sitting down and having a review about your true tax efficiency and your strategy, especially when there's major changes such as Section 24 come into play. It's always good to look at those and make sure that you are being truly tax efficient, but also you're looking towards that end goal, which is the future.
Yeah.
It's all about future development. Tax is one of the biggest expenses you'll have, so ideally you want to minimise it, but at the same point in time, you don't want to take unnecessary risks.
Yeah.
You want to make sure that you're within the rules effectively.
Yeah. Pay a lot of people. I even have people message me about offshore accounts and all this stuff, and I just think, just stick within the rules, pay the taxes, and do what you're supposed to do and build your business properly.
There are some, I completely agree with you. There are some things that you can actually do to actually mitigate your tax liabilities. But often there's a saying, if it's too good, if it sounds too good to be true, it often is. And if we go back to when we first started this, effectively the responsibility is on the taxpayer.
Yeah.
They're the ones that are signing it. What you might find, and I've seen this personally, where people have entered into tax schemes, it's been sold, it's been allowable by law, and then what happens is HMRC change their opinion, the law gets changed, and they go back and they claw the tax. And the company that sold you the scheme effectively has disappeared, shut up shop, and they've gone. So there's no way that you can actually make the claim against, and you're left carrying that can for a decision that you've made previously. So it's always worthwhile checking out anything that sounds too good to be true.
Yeah.
Tax is meant to be fair and reasonable. and it's for the good of society. So you should always make sure that you pay your taxes, is what I would probably say.
Yeah.
As minimum as you can get away with legally, but you should pay them.
Yeah. Fantastic. Well, thank you so much, Nathan, for joining me today and
Thank you for having me.
It's been amazing to just answer some of these questions. Like I said, I get these questions all the time, and to be able to have a professional come in and actually answer them for people and give out information it's just brilliant. So thank you so much for coming onto the channel. Look, guys, if you are interested in investing in property, if you've got a company or you've got a property and you want to be more tax efficient, or if you're thinking about it and you want to make sure that you start off on the right foot, I honestly could not recommend Nathan and his company more. They've been so, honestly, you've been so helpful for me, my company, just the way that we have been able to progress and move forward. Like you said, it's not paying for a service, it's forming a partnership.
Correct, it's a partnership.
And I've found that incredibly helpful. So if you're interested in just getting kind of a discovery call in with Nathan, find out a little bit more about what he does, but also how he can help you, then make sure that you click the link in the description, fill in the form, and you can get a discovery call to assess your personal situation, how you can be as efficient with your taxes, finances, and all that stuff. So click the link in the description, fill in the form, and book in a call with Nathan. Thank you so much, Nathan, again for coming on to the channel. And guys, I'll see you in the next video.